Federal Reserve policymakers meet next week to decide what to do with interest rates. Michael Hanson, senior economist with Bank of America Merrill Lynch, is here. And Michael, let's start with that basic question. Will they or won't they change interest rate policy?
Yeah, at the meeting next week, it's extremely unlikely that Fed officials will change interest rate policy. I think it's an open question whether they go this year. The markets are certainly pricing the Fed not to hike until well into next year. So I think there's very little chance that we get any meaningful change in policy. We're going to focus on what they say that might be different, and that potentially could be interesting.
The last time Janet Yellen had a news conference following a Fed meeting, she did talk about keeping watch of what was happening overseas. And we certainly got news from China on the rate front, and we've got news this week from the ECB, at least concerns raised by Mario Draghi. Would you expect that there's some commentary around that this time?
Well, Yellen won't have a press conference this time around. The press conferences are every other meeting. So it's either a change in the statement potentially or comments we might get sometime after the meeting. In terms of the statement, they did note in September that recent events had gotten them a little bit concerned on both the financial markets and global activity side. And if anything, that data probably looks a little bit better today. They also say they're going to be monitoring conditions abroad. And I think that's really a key phrase because, as you pointed out, both the ECB and the Chinese central bank have indicated that they're going to be easing policy on a forward basis. I think a lot of people in the market see that as something that would stop the Fed from going. But if you listen to the way the Fed talked about it, they're worried about downside growth risks. And so if other central banks are stepping in to help offset those risks, that probably makes their lives a little bit easier.
Michael, is there anything that would weigh in the favor of an interest rate hike before the markets are pricing it in next year?
Oh, for sure. I mean, look, we've already got an unemployment rate that's pretty darn close to the Fed's longer run expectations. I think that some combination of continued job growth, which seems likely, we're still looking at above trend GDP, and some further tightening the labor market because the participation rate seems to be inching lower, could very easily put us at an unemployment rate that's going to make the Fed officials very uncomfortable with zero interest rates. So they got to trade that off against the fact that the growth backdrop globally is perhaps a little soft, and the fact there's really no signs of inflation. And that's the big conundrum for the Fed. But the labor market has been one of their focuses. And a strong continued sign that the unemployment rate is coming down could potentially lead the Fed to hike well in advance of when the market is anticipating.
And what is the risk of waiting too long to hike at this point?
The risks probably are not high. The risks would be that you either see some faster acceleration of inflation than you're expecting, and that may actually force the Fed to hike much more aggressively than the market's anticipating, and that could, of course, be somewhat destabilizing. Or that you were to get bubbles in the market. And there certainly was, over the last year or a couple of years now, some concern that you were seeing bubbles coming up. I think a lot of those bubbles have since burst to the extent that they were there. But if you were to see that on a forward basis, because the Fed remained with low rates for a more extended period of time, that could potentially provoke a more sharp Fed response, and that could itself be a drag in the economy or even destabilizing for markets. So there's the risk.
At this point, do you expect much volatility in the markets between whatever happens in October and then the December meeting?
There's certainly some chance, right? Because we're probably going to get a little more news on what the ECB is or isn't doing. We may get further policy action out of China, and to the extent that the market is anticipating those moves, just how this communicated could create some volatility. And of course, there's still about 2 months of data between now and the December meeting. And any kind of surprises, upside or downside, I think could have some impact on market expectations. And so yes, you could very well see a little further volatility, even with the Fed doing nothing next week.
Michael Hanson, senior economist with Bank of America Merrill Lynch. Thanks for your time.
Thank you.
I'm Rhonda Schaffler for The Street.